Good afternoon, everyone. Welcome, to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers, and they're on the house. Great to be back live. Last couple of weeks, we had to do a recorded segments due to some scheduling conflicts. So, coming to you live from the Palm Springs and Greater Coachella Valley area. We're having another postcard perfect day in terms of weather. Lots of bright sunshine and very comfortable in the low 70s. So, Jeff often kind of teases me about a sports report. Of course, my my favorite season's over, baseball. Got the winter meetings coming up in about a week or so. That'll be interesting. But, we're getting ready for the college bowl season. And here's a trivia question for you. Any idea how many college bowl games there are in the U.S.? It's a remarkable number, 47. So those will be starting here, I think, in the next week or so. So if you haven't gotten enough football yet, it's going to be the major part of the calendar over the next month or so, with both, of course, the NFL as well as all of those college bowl games. So with that, let's go ahead and give you an update on what's going on with the market, interest rates in particular. Mortgage rates, that is. We always like to start by showing you our rate grid page right on the homepage of our website. It's just more of the same. Rates continue to be hanging in there. We have pretty much high fives in just about every product category, from conforming conventional, including the buy downs, FHA, VA, or of course in the lower fives. And even the jumbos are right there under 6%. So again, more of the same, more stability. We haven't had much of a change in terms of mortgage rates up or down for quite some time. And of course, part of what's going on there is, in fact, Jeff's going to pull up the 5-year chart of the 10-year bond yield, and then you can see a little bit elevated this week from where it was last Friday. But nonetheless, it's still been in a very kind of stable range. The 10-year being anywhere from about 4% up to around, it's gotten as high as around 4.15 here of late, but more or less between the 4 and 4.1 range. So again, very stable. And of course, what's going on now is we've got the next Fed meeting, the last one of the year, coming up next week, next Tuesday and Wednesday. So of course, what tends to happen there is the markets kind of go on pause, at least the bond market, waiting for the outcome of that Fed meeting. And of course, in the Fed funds futures market, very, very high probability now is the bet that the Fed is going to lower the Fed funds rate 0.25%. But again, even if that were to be the case, as we've talked about on this show a lot, don't pay too much attention to that. In fact, I always say ignore the Fed, because why? Just because they might go ahead and lower the Fed funds rate next week, and that'll happen on Wednesday, late morning our time, that does not necessarily mean that mortgage rates are going to get any better at all. In fact, the last couple of times the Fed has lowered the Fed funds rate, mortgage rates actually got a little bit worse after the announcement, not better. So the key part, if you're looking to lock in a rate between now and next Wednesday, is watch that 10-year yield over the next couple of days, tomorrow, Monday, Tuesday. Sometimes you can see that yield start to trend downward in anticipation of the meeting. And then once the announcement's made, sometimes that bond yield jumps back up. So if you're at a point where you need to lock in the next couple of days, I would say in particular, pay attention to next Monday and Tuesday and see what that bond yield's doing, that 10-year bond yield's doing. That might be able to give you a little bit of a hint if it's the right time to lock. Now, in terms of what's going on in the market, the financial markets, the bond market, as to establishing where these rates are at right now, again, more of a light week as far as economic data points. The government shutdown's over, yes. That, of course, was disrupting data reports, all the critical data that the markets react to. All of that was getting delayed and put off. And so we have really more of the same. We're kind of in a catch-up mode in terms of getting economic data out. But there was some data released this week, albeit not a great deal. For one, the U.S. manufacturing PMI index came out this week. Solid growth. Numbers look good. So all this talk about the economy is weakening, that didn't seem to be borne out by the manufacturing, the U.S. manufacturing PMI report that showed strong numbers. Probably the biggest news this week was the ADP employment release. Now remember, ADP, as most of you may know, is a payroll processing company, but they publish a report as to number of new jobs, new private sector jobs. The ADP report does not include government jobs, only private sector jobs. And it did surprise the market this week, down 32,000 rather than a 40,000 forecast, 40,000 new jobs forecast. ADP ended up coming out saying, nope, sorry, it's actually down 32,000. And of course, to some degree, it's, it seems to be mostly on the small business side. And there's some belief that maybe the government shutdown had a bit of an effect in terms of that number. So it could be a kind of a one and done kind of a situation. Nonetheless, yesterday we saw the bond yield, get a little bit better because this was released yesterday. We were down to around 405. So, but beyond that, not much else to report. The U.S. Services PMI index did come out this week, also showing solid growth. And then today, the initial claims for unemployment was released. The forecast was 220,000 claims for unemployment benefit. In reality, it dropped to a 3-year low, 191,000 claims. So again, a bit of a surprise. This kind of number dropping by that amount would suggest the labor market maybe isn't so bad. Although again, in this case, the Thanksgiving holiday is being pointed to as maybe being a part of the reason that number was lower than expected, because having, if you lost your job right before, the Thanksgiving holiday, you may have not jumped right into filing a claim quite yet. You may have put it off until this week or maybe even wait till next week. So, and then finally, the only other data that's going to come out this week is tomorrow. And it's the Fed's their actual favorite inflation number, the Personal Consumption Expenditures Index, the PCE, that will be released tomorrow. That can be a market mover. However, again, because of the government shutdown, what they're going to release tomorrow is a delayed report. They're going to release the numbers of the PCE number for September. I mean, here we are in December. So how much that's going to affect the market, the bond yields in particular, hard to say, given that the numbers we're going to get are, in the past by almost 3 months now. And so my guess is whether it's stronger than expected or more benign than expected, I'm not sure there's going to be much of a movement in the market based on that release, only because the data being released is basically really too old, I think, for the markets to react to. So hopefully in the next couple of weeks, we're going to finally get those folks who calculate all of these economic data points are back up to speed, back on schedule, and we can start getting economic data points, in real time as they're happening. And I think that way we'll get a better feel for where the market's going, both in terms of the strength of the economy, growth in the economy, as well as where we're headed in terms of interest rates. So with that, we're going to go ahead and get into a discussion regarding in our product spotlight this week. Not really a product spotlight in the sense of something that is a known and well-known product in the U.S. mortgage market, but a new idea that has come up to try to help with the U.S. mortgage market, and that is the subject of a portable mortgage. So yeah, as you can see from that image, can you imagine taking your mortgage and selling your house and buying a new one, and then just take that mortgage and pack it in your suitcase when you move to the new house? Well, it doesn't quite work that way, but we're going to get into that a little bit with Jeff and talk about the pros and cons of the portable mortgage.
Hey, Art, how you doing?
Good. How are you?
Good. Hey, thanks for that. The bowl tip. I had no idea there were that many football bowl games. I was guessing there might be 10 or 15, but 40. How many?
47.
Oh, that's crazy. That's crazy.
Yeah. Well, you see, I think what's happened is they've expanded that kind of format so that even if you want to be kind of tough about it, even the losers get to play in a bowl, because I think that the key point is that if you finish your regular season at least at 500, like 6-6, then you're going to get into a bowl. But of course, it's going to be a bowl that's going to have some probably funny name because of some obscure sponsor. And of course, when it's on TV, the camera will be really focused on the field because they don't want to show too much of the stadium because it may not have a whole lot of people in it. So I don't know. It's fun. I mean, I like watching football. It's kind of nice to have in the background. And so, yeah, you imagine 47 bowl games in 40 days or something. It's crazy.
That's amazing. You might have to put like a sports bar in your house with like 10 TVs just to keep up.
There's probably some people who have already done that.
Yeah, I'm sure that will make the wives very happy, or let's say non-sports spouses. But let's get into today's talk. The government, it seems like, Art, they're really trying to do things. You've talked about, the 50-year mortgage and what the pros and cons are. And is that a reality? Well, now here comes along another conversation called a portable mortgage. Now, for most of us, we've never heard of that. Right. Even if you ask somebody who's not as well, I shouldn't say seasoned, but or as an expert as you are, would have no idea what that even means. Right. So maybe the first thing, if you could do is first of all, are portable mortgages even available in the U.S.?
Well, basically, no.
Okay.
And we're going to get into the details of why that is, but no, a portable mortgage has not really been on the scene or in the scene of the U.S. mortgage industry at all. So in that respect, it would definitely be a unique concept. And I would agree with you that the fact that this has kind of hit the news here in the U.S. exemplifies the fact that, give them an A for effort. The federal government seems to be at least trying to look at unique and different ways to try to address this affordability problem. And so the latest news is after the 50-year mortgage idea hit the news feeds, which, of course, sorry, folks, I tended to be one of those ones that was kind of a naysayer because I just don't think it's a viable product really going forward. But now the portable mortgages hit the news, again, because the federal government, as they should be doing, are looking into what can we do to change the landscape and help people be able to more, better afford homes and get into home ownership. So, again, give them an A for effort. But, again, it's something that's not available now. And so the focus is going to be how viable can it really be? And if it does appear to be viable, what kind of changes in the structure of our U.S. mortgage industry would have to occur to make this work? Because this is done in some other countries, such as Canada, UK, and so forth. So this product is out there, just not in the U.S.
Well, let's start out with, because again, very few people probably understand what a portable mortgage is. We think of something portable, it's like, hey, we just take it with us where we want. Right. Is it like that? So give us an idea of, first of all, let's talk about, a definition. What is a portable mortgage?
Well, the basic idea with a portable mortgage, and when you think about it, it's kind of logical, is, you own a home, you have a mortgage. And of course, as has been beat to death in the news over the last couple of years, there's a very large percentage of the housing stock that have a very low rate mortgage that they got either because they bought a home during the pandemic or they already owned a home and they refinanced into a very low rate. So the idea with a portable mortgage is to help sort of unlock the market, because we know about a lot of these homeowners, while they might be interested in selling, they don't want to sell because they don't want to give up their 2.5% or 3% mortgage. Yeah. So the portable mortgage concept is, imagine this: you decide, I'm going to sell, and I've got a $300,000 mortgage at 2.5% on my house, and I can sell it for $800,000, and so I'm going to do that. But then when I sell my house, my $300,000 2.5% mortgage will not be paid off. Instead, I'm going to enter into escrow on another property I want to buy, and I'm going to move my mortgage, my 2.5% mortgage, from my current home to the new home that I'm buying. So that's the basic, in the most simplest terms, what a portable mortgage is. You decide you're going to sell, buy another, and you're simply going to take your existing low rate mortgage, move it to the new house. So it's a pretty simple idea, and at first glance, pretty attractive.
Yeah, I mean, wouldn't it be one of those things where, we talk about home values going up and things like that, but wouldn't that make it like, it would just, as you say, it unlock this inventory of people who have the low interest rate that says, hey, I'm not going to leave. and get something else because I don't want to go to that higher interest rate. I can just take that with me, and at the same time not see a deflation or a flattening of the value of their homes.
Well, exactly right. And of course, that's the whole point of the portable mortgage, why it's being looked at, is what can we do to get all of these homeowners with this COVID 2.5% mortgage and get them off the fence and put their home on the market to sell. Because we know it's been, well addressed in the media. A big part of our problem is we don't have enough housing supply.
Yeah.
And a component of that is all of these homeowners who in a more normal market, who didn't get this once in 100-year pandemic mortgage at 2.5%, a lot of these folks probably already would have listed their home and already sold. In other words, we would already have more inventory than we currently have, but we don't. This idea is pretty much laser focused on, is this the way to get all of those homeowners off the fence, put their home on the market for sale, which of course, what does that do? Increases inventory, which of course will help with the housing shortage problem that we have.
So this particular idea being proposed or being discussed, if you will, about the portable mortgage has really nothing to do with the 50-year mortgage, because that's attacking it, or I should say supporting a completely different audience. Is that what you're saying?
Right, exactly. I mean, and in fact, part of the reason this portable mortgage idea, I think there's been a little bit of criticism about in the US, is that if you think about it, this idea, who does it benefit? It benefits the existing homeowner who already has this very low rate. What does this idea do for the renter who wants to stop renting and wants to buy? Well, they don't have an existing 2.5% mortgage to take with them because they don't own a home. They don't have a mortgage. So what does this do to address all the renters out there who want to become homeowners? Well, frankly, it does nothing, because you don't own a home already. You don't have a low rate mortgage to move to your new house. So that's part of the criticism of this idea, is it certainly focuses on a segment of the market, a segment of homeowners or prospective home buyers, but not all of them. A good portion are still kind of left out there having to deal with rates being where they are, which is not 2.5, but more like closer to 6.
Yeah. Well, let's talk about the pros and cons, and because you always do such a great job. You did that with the 50-year mortgage, going, hey, here's the positive, here's the negatives, and then here's the reality. So right. I'll turn this over to you, and let's just walk through the pros and cons then.
Okay, sure. Yeah, one of the first pros and cons. Well, of course, the first, if you want to get into pros about a portable mortgage, as we all just, me and Jeff just talked about, of course, the first thing is the biggest benefit or pro is that you get to take and keep that low rate mortgage and move it to the next house that you're going to acquire. That's obvious, right? We just talked about that. Well, what's another pro to having a reverse mortgage? Well, not so much here in the U.S., but again, in some of these other countries like Canada, like the UK, prepayment penalties on mortgages are common. In fact, almost a majority of the time when you get a mortgage in the UK or Canada, you are going to have a prepayment penalty. And some of those can be as much as 3 to 5 years. So one of the benefits of this portable mortgage idea, and why it does get used in a limited fashion in some of these other countries, is because if you have that low rate mortgage and it does have a prepayment penalty, well, then guess what? If you're allowed to move that mortgage to the next property that you're going to purchase, you don't incur the payoff penalty because you haven't paid off the loan. You've simply moved it from one property to another. So it can save you quite a bit of money by avoiding the prepayment penalties that are already built into that mortgage that you want to move from your current home to your next home. And then the other thing is, it can help you in terms of making the move more quickly. The reason being is that if you already have a mortgage on your house and you're going to sell it and you're going to take that mortgage and transfer it to the house you're buying, well, if you think about it, you're not going to have to go through the new loan process. You're not going to have to go through applying for a mortgage, putting all your documentation together, get it underwritten and approved. that piece of the process is essentially eliminated because you're not getting requalified for a new loan at current rates. You're simply taking an existing loan, moving it to the new property, and that theoretically should help, accelerate the process of getting your current home sold and buying the new one, because you basically, bypass that loan qualifying and loan underwriting step. But can take some time. Typical deals can last 30 days or so. So that obviously can help you in terms of just moving more quickly because you don't have to requalify for a new mortgage. You're just moving the existing one that you have. Now, there's some drawbacks, though. I mean, it's not just all good news about this portable mortgage idea. The one con, and I think a fairly significant one, is you might need to get that, they call it a top-up loan. You might have to get secondary financing, because think of it this way. In fact, I want to point out something that maybe a lot of folks don't understand, but it's a subtle point, but a very critical one. If you have that low rate mortgage, you're going to sell your house, buy another, and you want to move that mortgage to the new house. Keep in mind that when you do that, that mortgage balance that you're moving from your current house to the new house is not providing any dollars to the seller at whatever price they're asking. So what that means is when you sell your current home and you move your current mortgage to the new house, you're not paying off your existing mortgage. So what that means is your sale proceeds are going to be higher because you're not going to have part of that used to pay off your existing loan, since it's being transferred to the new property. So you're going to get payoff. You're going to get higher proceeds, essentially as if your home was free and clear. But then if you're buying another house and it's at a higher price, well, you're basically going to have to take all of those proceeds to the new house. And that might not be enough if the new house price is significantly higher than your current home and the mortgage balance you have on it. So as a consequence, you may have to make up that gap by getting secondary financing. In other words, you don't have enough cash even after applying all your sale proceeds to the new house where you're transferring your mortgage to. You may have to have other cash to provide, kind of like more down payment. And if you don't have enough to cover the gap entirely, you may have to get a second mortgage, be it a HELOC or a fixed rate second. And of course, those are at a higher rate. And those higher rates, of course, start to diminish the benefit of the lower rate on the mortgage you're transferring. And so you get into more of a blended rate situation where it's still going to probably be more beneficial to transfer that loan, to port it, as we call it. But still, you have to keep in mind, you may have to get a second loan to make this process work. And then, of course, another con is not every loan is portable. Now, as we've already talked about, in the U.S., virtually nothing is portable in terms of a mortgage right now. It's being looked at. But in some of these other countries where portable mortgages are available, they're not available on every type of mortgage. Not every mortgage type can be ported. They are not portable. So you have to realize that even if we can get to the point where this idea gains some traction and might have some possibilities in the U.S., be prepared for the fact that probably not all mortgages available are going to have this feature if it comes to be. And then another con to think about, and again, I've read a little bit about this in other countries that have a portable mortgage. You have to move within a certain period of time, which actually makes some sense. In other words, think of it this way. Again, let's pretend here for a minute that the U.S. allows portable mortgages. So you've got your home, you're going to sell it, you've got your mortgage, it's a 2.5%, 3%. You want to transfer that mortgage to the new house. Well, then you've got the challenge of when are you going to get into escrow on the new house? You may not be able to time it as such to where you're going to get your current home sold with the mortgage that you're going to transfer. You may get that done quickly, actually. And then maybe you haven't found the house you want to move into and opened escrow on that. So you could have this period of time in between where maybe you've got your current home in escrow, you're preparing to transfer that mortgage to a new property, but you haven't found the new property and opened escrow on that yet. So you could have a gap in time between when you potentially could even get your current home sold. And then you got this mortgage kind of flapping around in the breeze that you're waiting to find the new house to transfer it to. that can be very problematic. And so you have to consider that to that extent, you will not probably have, if we get these here, a very long amount of time to transfer that mortgage, to port it to the new property. You're going to have to kind of time your sale and your purchase very tightly close to each other, so you don't have this mortgage that's, for some brief period of time, technically not secured by anything, because maybe you sold your current home first, but you didn't quite get to the point of finding the new home and making an offer, getting it accepted, opening escrow on the purchase side. So that is a con that you have to be considerate of with this kind of mortgage idea, because the timing is going to be very, very important.
Art, can I have a couple of follow-up questions on this?
Sure.
I'm just, we're talking specifically about the actual homeowner or the borrower. But when we talk about pros and cons, and again, I don't expect you to be, this could be speculation, because we don't do these mortgages here, even with your expertise and time in the business. But are there pros and cons to this as a lender, and how can they do that? One thing I understand is, here in the US, we typically do 30-year fixed mortgages, but where a portable mortgage is in place, like in Canada or UK, it's a little different, isn't it?
A lot different. One of the fundamental issues with this idea is how unique the U.S. mortgage market is. Unlike most of the rest of the world, we have 30-year fixed rate loans. That's pretty unheard of in the rest of the world. Most everywhere else, in Canada, UK, and other parts of Europe and so forth, they don't have 30-year loans. They're shorter term. And in a lot of cases, probably a majority of the cases, they're not fixed, they're variable. And of course, we talked earlier, many of them have prepayment penalties. And the other fundamental difference with the countries that have this type of mortgage product, their mortgage industry is fundamentally not security based or securitization based. Remember, in the US, and this is part of the con list, it kind of starts to get longer. In the U.S., the U.S. mortgage market is founded on the idea of securitization. Almost all mortgages are pooled together, and they serve as security, or the homes. The mortgages serve as security for bonds that are being sold in the secondary market. So the challenge here is, how do you maintain that kind of market here when you've got this mortgage that you're suddenly going to move around from property to property? I mean, for example, when the loan is made, it's going to go through underwriting. It's going to be based, how it's priced. It's going to be based on things like credit score, your income to debt ratio, but also the collateral. What kind of property is the mortgage secured by? And a mortgage will be priced differently in the U.S. because of the securities market and the fact that they are pooled together as collateral for bonds. How the mortgages are priced is very much dependent on the property type: single family, condo, duplex, triplex, fourplex. Each of those property types have an effect on how the loan is priced in the securities market. So consider this. You've got a $300,000 house or loan on your current house, and it's a single family detached home. Maybe you're an older couple, you're selling, and you're going to downsize into a condo. Well, wait a minute. That mortgage that you first got on your single family detached home, it was priced in part based on the property was a single family home, not a condo. Now you want to move that mortgage over here to another property you're buying that's a condo. Well, condo is considered a more risky property type. So how is the market, how is our industry going to deal with the fact that, and more importantly, how are the investors going to accept, the investors of those mortgage-backed bonds? They're going to go, well, wait a minute, I made this investment because I understood the collateral was all tied to single-family detached homes, which are a safer property type. Now this mortgage I've invested in, is you've moved it over here to a condo. which is a more risky property type. So how is the U.S. industry, securities industry, how are we going to tweak the system to account for that? You start to think about it, it's like, well, wait a minute, that's a very tall task. And it gets into another part of the U.S. industry here as it relates to securitization of mortgages. I've talked before about prepayment speeds. It's not a coincidence that the 10-year bond yield is a good benchmark for mortgage rates, in fact, maybe in large part, because the average mortgage life in this country, I've mentioned before, is 7 to 10 years. And of course, what does that do? The duration of a mortgage and the anticipated prepayment of a mortgage is part of the parameters that goes into how these loans are priced when they're being served as collateral for bonds. So then what you realize with the portable mortgage idea, it would basically completely change the duration and prepayment speed analysis of mortgages, and new assumptions would have to be made about the expected life of that mortgage, and the expected life is going to have to be extended if mortgages can be moved from house to house. Well, what does a longer duration of a mortgage mean? Higher rate. The higher or the longer the duration of that mortgage, an investor is going to demand more of a premium, i.e. higher rate, to account for the fact that that loan is going to have a much longer duration than what the average duration is now in the U.S. for a regular conforming FHA VA mortgage. So those are a couple of technical issues associated with this idea that are very tall tasks to figure out, and in doing so, still keep the market fairly simple, straightforward, and efficient.
I mean, it seems like there is so much history and regulation and standard operating procedures that the idea to change that is probably is it even realistic?
I don't think so. I mean, again, when you consider the fact that we are our mortgage industry it's essentially Wall Street based, if you will, to put it in kind of simple terms. Like I said, almost all mortgages here are pooled, and they're security for bonds, mortgage-backed bonds, what we call Ginnie Mae bonds for where FHA and VA loans are used as the collateral, and that kind of process. It's highly technical. There's a lot of data points and parameters of a mortgage that are taken into account. So it's very detailed and kind of tedious, but it's really pretty efficient, and it's what helps keep rates down because of all these factors that go into determining what the rate's going to be. The portable mortgage idea kind of just, you throw that into the mix and it's just going to explode everything. I mean, it's like I just commented on, it's like, how do you securitize these mortgages if you're of the belief that some of these may last a lot longer than they were expected to, and many of these are going to end up being moved from secured by one type of property to a whole different type of property that's more risky? I don't know how the market can officially account for those potential changes in the life of the mortgage in order to maintain rates as good as what we have now, even though people complain it's too high. I mean, this kind of reminds me of the 50-year mortgage idea, because what I tried to point out is the 50-year mortgage, where everybody misses the real point, the real weakness of the idea, is you're not going to get a 50-year mortgage at the same rate as a 30-year mortgage. It's going to be higher. And if we decide we want to have portable mortgages in the U.S., we're not going to get those at the rates that we currently see. They're going to be higher. They're going to be higher because that portable mortgage is going to have a longer duration, and it's going to be higher because the portable mortgage will have the possibility of being moved from a less risky property to a more risky property. And so as a consequence, overall, that portable mortgage, if it even hit our market here, the rate's going to be a lot higher. And then it's going to undermine the whole purpose of the idea because of that fact. And again, that's what the 50-year mortgage was, the weakness. In fact, I still see presentations online where some folks in my business and my industry say, "Oh yeah, 50-year mortgage is great. Here's the payment at 50 years. Here's the payment at 30 years." The problem is they're using the same rate for both. You can't do that. I mean, that's just fundamentally, that's missing the whole idea of how the current market works. So, and it completely undermines the supposed benefit of a 50-year mortgage. I think we got somewhat the same thing going on with this.
Do you think and maybe this is for another program, but I think of that when loans, I think they're particularly VA loans, and I think they may still be, you correct me if I'm wrong, they are assumable. And could that be another possibility? Because now it really benefits the new person coming in. So if I have a 3% loan, if you will, and it's now assumable, now those renters have some place to go. But then again, I'm back in that situation of like, well, I'm not going to go to a 6% or a 5.75% rate. Do you see any possibility there? And again, this is a soft toss to you to think, maybe that's for another conversation, but it's curious if this doesn't work. And I'm glad that, as you said at the very beginning, the government's trying. They're trying to put some ideas out there. These are just two that seem to have some short sounding wins, but when you unpack them, you're going, whoa, that's Pandora. Let's put her back in the box.
Well, yeah, I mean, see, this underscores part of the fundamental problem with the portable mortgage idea. We've talked in the past about how there's sort of these two camps. The younger generations who are renters and frustrated about home prices are too high, rates are too high, and they can't get into buying a home. And they're kind of envious of, kind of almost jealous of, and sort of almost mad at the baby boomers because they feel like they got all the homes and they all got 2.5% rates. And so they're winning in the U.S. housing market. So all those old homeowners, they're the winners, and us younger renters, we're screwed because we can't get into the market. And again, that's part of the problem with the portable mortgage idea is I think it would even increase that sort of tension between the two camps, because it's going to be looked at as, another benefit for those baby boomers who already own all the homes and already all have low rates that we wish we had. So that's the problem with the portable mortgage idea. And so, yes, the counter to that is there are a lot of homeowners with 2.5%, 3% mortgages that are FHA, that are VA. So if they just finally decide to sell, they should be marketing the heck out of the fact they have an assumable mortgage to help address the concern that the renters have, those who have been shut out of the housing market. But if you're an owner of that kind of mortgage and you're going to decide to sell and market that your current mortgage is assumable, great. That may help you get the home sold faster. You're addressing the housing shortage issue for all of those renters who are frustrated. But then you as the seller, when you go buy that next home, you're not going to have that benefit that the portable mortgage gives you. You are going to be faced with today's higher rates. So that's where this is an idea that kind of addresses part of the market, but not all the market. And I think even if we were to do the portable mortgage, we're going to have half the market, half the potential people out there are going to be pretty unhappy because it's going to do nothing for them to solve their problem into getting into home ownership. It's just not going to work. So,
do you see a I don't want to say a one size fits all, but do you see a remedy to this that maybe you up late at night or getting up really early in the morning think, why don't we do this? Is there something out there you feel like could help both sides of this coin?
Well, I can't say that I see anything in terms of some sort of other mortgage product innovation. I mean, because at the end of the day, I hate to say it, but the numbers are the numbers. I mean, money costs what it costs right now. And unfortunately, home prices have gone up. I would have to suggest again, if you're a owner of a home where you've got an assumable mortgage, you should market the heck out of that. And then on the buying side, when you're looking to buy and you're concerned about today's quote unquote high rates, even though historically they are more affordable than historical rates are, pay more attention of how to negotiate a purchase where you're going to get some seller concessions and use that towards your financing. I mean, we're doing that quite a bit. I keep pounding that drum that's the way to solve this issue. Sellers can do that to help the buyers. Those prospective buyers, you need to be more aggressive, especially now because we have a little bit more of a buyer's leverage situation going on. Be more aggressive about making an offer and getting concession dollars to attack your loan terms and get them more affordable. I mean, I just saw a presentation of numbers here in our local market in Palm Springs. The list price to sale price, it's about 96 now. In other words,
Oh, wow.
listings are selling at about 96% of list price. Well, what's the difference? 4%. Can you do something with 4% of the price of the home towards your loan? Absolutely, in a big way. So that kind of data is what tells, I think, prospective home buyers, go out there. There's more homes to look at. Inventory is up. There's a lot more homes to look at. There's not that much competition. So you're not necessarily going to be running into multiple offers. And you're going to have some sellers who are going to be a little bit more antsy and more willing to deal. So go look for that house. Decide on a house you like, make full price offer, but ask for 4% in seller concession dollars. Let me show you what I can do with that on your loan. You'll be very pleasantly surprised.
Well, Art, as always, this is great information. And again, I know people might be tuning in and says, well, what is this portable mortgage you guys are talking about? It doesn't exist here in the U.S. right now. It's something that's being talked about. And what we wanted to do today is I want to put Art in a situation where, hey, explain what it is, how is it used around the world, why it could be used, but probably unlikely because of our system that we've had in place forever. It may not be the best choice, but then find out, hey, what would be the solution? And I'm hearing you say seller concessions, buy downs, and that would be the play.
Yeah, I think so. And the data supports that. Again, the market's moved a little bit, and I think buyers have a little bit more advantage than they used to have. And I think sellers are a little bit more flexible, we'll say. So I would urge people, I know it's holiday time. Actually, that can be a very good time to go look around and use those tools. I can help you with that, and you can be very pleased with what you can accomplish in buying a home right at this moment. So,
yeah, here's Art's information on the screen here. You can call him in his office, 760-969-5023, or you can call him on his cell phone. He never leaves home without it, 714-612-9035. You can always go to the website, mwloan.com. You saw the rate grid when we first opened. That is constantly being updated to give you information about that. And of course, you can always email Art at mwloan.com. And I want to thank you for showing up. Art, thank you again. I'll bail out, and we'll see you again next week.
All right, thanks. Thanks, Jeff. Thank you, everyone, for watching and listening to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Have a great weekend. I know we're in full holiday swing, so you probably got parties and shopping and all kinds of fun things to do. And of course, get ready. We've got 47 college bowl games coming up. So again, have a good weekend. I'll see you next week on the next edition of the Mortgage Minute. So long. Take care.